My name is Henrik Gustafsson. I work at Googol, and we help clients to develop their innovation capabilities. The backdrop to today's sharing and learning session is the ongoing shift towards long-term corporate behavior and the shift from shareholder to stakeholder economy. This topic is very broad, but also an important topic with respect to the potential we see regarding the role innovation management can play in long-term led companies. On a practical level, have you ever felt frustrated when innovation initiatives that you know are necessary for the long-term success of your company is down prioritized to make the quarterly targets? Or that you can't get funding for sound innovation projects because there's no budget to fund it? In a nutshell, that is what we'll be talking about today. Let us begin with looking back at what has led us to where we are today on this topic. In the aftermath of the financial crisis of 2008, numerous leaders drew the conclusion that short-termism had gone too far. Once again, the capital markets was inflated by short-term and selfish behavior. The result was a financial crash that put the whole world in deep recession. Well, at least most industries. The big 5 tech companies was thriving and grew exponentially with their disruptive business models. One of the key learnings was how they focused on building capabilities for the long term, and how ambitiously they exploited the digital opportunities. New disruptive startups kept popping up. The pressure to acknowledge the opportunities of digitalization increased. The management consultancies talked about the need for digital transformation due to the fast-paced market change. The main focus was digital solutions, not the least e-commerce. The main pain was that IT was mostly a supporting cost center and not a strategic business enabling function. Operational excellence was yesterday, and customer experience, design thinking, and agility was the new black. It was time to pursue change for real, time to transform the business. Soon enough, it was no longer just a tech issue, but a top management issue. The change was about people, especially managers, who were supposed to lead while faced with many new terms and concepts. Quotes of legendary consultants and business leaders came frequently to use. The greatest danger in times of turbulence is not the turbulence, it is to act with yesterday's logic. When the rate of change outside an organization is higher than the rate of change inside, the end is near. Innovation is change that creates a new dimension of performance. Drucker and Welch both stressed that change and innovation go hand in hand, which was an important message at the time. But they both had a traditional shareholder-centric perspective on value creation. Increasingly, this perspective was problematic for many progressive business leaders. Short-termism was on the rise again. This is research by FCLT Global and McKinsey from 2016. 87% of executives feel pressured to demonstrate strong financial performance within 2 years or less. 65% say short-term pressure has increased over the past 5 years. 55% of executives in short-term led companies would prioritize quarterly targets over long-term value creation. At this time, many business leaders are concerned over this increasing short-term pressure. The capital markets, however, are still mildly concerned about the risk involved with short-term led companies. But this is about to change. In 2015, the Global Goals for Sustainable Development was launched. The Paris Agreement was signed. The climate crisis was finally acknowledged. Perhaps not wholeheartedly by all business leaders and politicians, but a critical mass of the general public was convinced, and many in younger generations in particular. Now we had a checklist for what was good and bad. By this time, most people are online, and practically all millennials are active in some form of social media. We discovered the millennial effect. The millennials are not responding well to conventional mass marketing. In fact, they don't trust brands in general, but prefer brands who can relate to their values and lifestyle. They trust their friends, and are keen on endorsing brands expressing their values and lifestyle by word of mouth or in the digital channels. They are critical of brands who are not authentic and quick to let them know. Together, Generation X, Y, and Z make a huge difference. The interests of connected consumers and society have a strong and powerful voice. Brands must pay attention. In 2017, FCLT Global and McKinsey present interesting research involving 615 publicly listed large to mid-sized US companies. The study is based on a 5-factor Corporate Horizon Index, which captures patterns of investment, growth, earnings quality, and earnings management. The results are crystal clear. Long-term led companies perform much better 5 years after the financial crisis. 47% higher revenues, 36% higher earnings, a staggering 81% higher profit, and 58% higher market capitalization. In August of 2019, Business Roundtable in the US announced a new statement on the purpose of a corporation, signed by 181 CEOs, who commit to lead their companies for the benefit of all stakeholders: customers, employees, suppliers, communities, and shareholders. Its previous position was that corporations exist principally to serve shareholders only. Signing companies include many sectors: energy, steel, airlines, telecoms, technology, consultancies, retail, consumer goods, automotive, health, pharma, banks and finance, and more. In the US, this was big news. What it will mean in practice can be discussed, but it was an important principal statement to the capital markets. In 2009, the environment was not even on the agenda of World Economic Forum. In 2020, the Davos meetup was basically a climate summit. At the 2020 meeting, the Big Four accounting firms issued a white paper on how organizations should measure the ESG goals based on 4 pillars: governance, planet, people, and prosperity. Having a common reporting format makes it possible to gain better insight and compare how organizations perform. This was widely adopted by political policymakers, including the EU. The capital markets have responded. Stock exchanges are making it increasingly easier to select sustainable investments. Investors are increasingly proactive in making sustainable and long-term investments. Governments are introducing new tougher frameworks for ESG reporting. In practice, it is foreseeable that it will be a requirement for companies to assess how sustainable their business is and to disclose what their plans are going forward. New recommendations will come in full force in January 2022 in EU, and for some actors a subset already in March 2021. It is notable that Swedish companies have been good at disclosing its position and status regarding sustainability. But it has also been noted that the progress towards Agenda 2030 is lagging. We have experienced quite dramatic change over the last decade. It is probably safe to guess that most of us believe that the pace of change will not slow down. Many companies have invested in long-term behavior and focused on building their capabilities in digitalization and sustainability in the last decade. Since such capabilities take time to build, these companies will increasingly reap the fruits of these investments in this decade. One trend that seems inevitable is that the demands for higher transparency will increase. What is it that successful long-term led companies do well? A recent follow-up on the study by FCLT Global and McKinsey in 2016 regarding the performance of long-term led companies, which I mentioned earlier, reveals that long-term led companies exhibit 5 distinct behaviors. This is a condensed summary. Investments officially play to win in the long term instead of not to lose in the short term. Value creation. Create long-term value for all key stakeholders, not short-term shareholder value. Portfolio management. Use a systematic approach to manage the portfolio of strategic change and innovation initiatives. Resource allocation. Use value-based dynamic allocation of capital, talent, assets, and businesses. Funding. Stay on the long-term course by resisting the temptation to take actions to boost short-term profits. Instead, keep up or even step up investment in strategic and innovation initiatives. Obviously, success in the long term is based on a viable and well-communicated long-term strategy. Managing expectations according to this strategy is of course a fundamental part. To succeed with that, it's important to be able to disclose the strategic initiatives and how they are playing out. To enable that, portfolio management is crucial. Note also that successful companies are good at dynamic resource allocation. It means that they are supervising their strategic initiatives continuously and reviewing their portfolio to top management at least quarterly, ready to reallocate resources as required on short notice. This in turn is the key to avoid a gap between strategy and execution. We would argue that what successful long-term led companies does better than others is to execute their strategy. They use an agile perspective on strategy and focus on continuously monitoring the execution of their strategic initiatives. To succeed with this, portfolio management of the company's strategic initiatives is of the essence. And in this context, which role does innovation portfolio management play? From an innovation management perspective, strategy is manifested by strategic initiatives, which in turn are either about change or innovation, or most commonly, both. When it comes to change, the starting point is generally known, as well as the destination. It is mainly about managing the transition of human behavior. When it comes to innovation, there is typically a clear direction, but the final destination is rarely known. It is an intellectual, iterative, trial and error oriented development process. So how does change and innovation interplay? Every innovation entails some kind of change, but not all change in relation to innovation needs to be managed. Not every change involves innovation, but all change needs to be managed, at least at some level. The key question here is to what extent innovation management is really about executing strategy. Too often we experience that innovation management essentially is about managing the development of new products and services, and that's a huge difference. Another key question, irrespective of the scope of innovation management, is how the change and innovation aspects of strategic initiatives interplay and how this relation is managed. Is it in fact so that both innovation and change often fail to happen because this relation is not working properly? We would argue that many companies have a lot of hidden potential associated with the role of innovation management and its relation to change management. Today, we will be talking about this in the context of the benefits of long-term corporate behavior and the growing stakeholder economy. Here are the three main questions framing our discussions today. What is the role of innovation management to support long-termism? What are the effects on how innovation efforts are funded and financed, taking multiple stakeholders into consideration? In what way should innovation management adapt to support this need and opportunity? We will talk about these questions in the upcoming panel talk, and then break down these questions further in the group workshops. With that said, we hope you feel energized and are looking forward to the upcoming discussions. Let's share and learn.